Well, credit card debt and homeowner insolvencies contributed to the highest pace of debt accumulation since 2011 in Canada. A new study from Michalos Associates finds the average insolvent debtor in Canada now owes more than $50,000 in debt. That's roughly a 10% jump from 2 years ago. Let's bring in Doug Hoyes. He's co-founder of Michalos Associates. Doug, thank us a lot for joining us. There are some big numbers in this most recent survey. Credit card debt is a huge part of the insolvency problem, it seems. I'm seeing that the average person who filed for insolvency had almost $18,000 of credit card debt on their books. Why is this happening?
Well, you're right, and that's a 13% increase from what we saw a year ago, and it's kind of obvious why it's happening, I guess, on the surface, which is that it's costing more to live, and so how do you make ends meet? We had an inflation rate of 10% for many months last year. What do? You put it on your credit cards. What's most distressing to me is that the person we are seeing filing insolvency is somebody with higher income than what we saw in the past. So a couple of years ago, the story was, people are using payday loans and rapid loans to make ends meet. Well, last year, the story, as you said, was, well, now they're using credit cards. What does that mean? Well, it means somebody who has the ability to borrow and get a credit card, in other words, somebody with a higher income and a higher credit profile than somebody who is perhaps using payday loans, is now the person who's becoming insolvent. So we're seeing insolvent people, in effect, moving up the income curve.
So I have, I guess, a general question, and I think it's a question on the minds of many people, especially investors. How long can people continue to spend, I guess? And I think that's what the Bank of Canada is going to be asking, right? Because I think after raising rates 10 times in the last few years, you would think that the consumer would be tapped out. And I guess a second part to the question is, we would think that the people that are, racking up the higher debt are people that perhaps don't have jobs. But I see here 82% of insolvent debtors were employed at the time. So this whole notion of if you have a job, then things are okay, it doesn't seem to be the case, does it?
You're absolutely right. And that's kind of one of the myths that, if you're going bankrupt, it's because you've got no income and you have no choice. Well, no, the reason you file a bankruptcy or a consumer proposal is I've got a lot of debt, but I'm working. I don't want the creditors to take me to court, sue me, and garnish my wages. So it's the person who is employed, who has something to protect, that is filing. Now, as to your question, how long can it go on? Well, it's already starting to crack. Obviously, as Paul said, we had an increase in insolvencies of 23% across Canada last year, 26% in Ontario. So the cracks are already starting to form. And I think it just gets worse and worse and worse. So high interest rates. Well, if I locked in my mortgage at a low rate 2 years ago, it's not affecting me yet. But as they come up for renewal, it begins to affect us. So I think we're just going to see increasing numbers, at least, for this year and perhaps for the next 2 or 3.
To follow Alan's question and taking note that a lot of people filing for insolvency do have jobs, how much of this is attributable to irresponsible spending?
Well, in my experience, it's a very low number. Sure, there are people who just spent too much, and I guess everybody with debt spent more than they made. But what we're seeing is it's the cost of living that's really, getting people into trouble. And of course, we had the lockdown period for a year or two, going back a couple of years. There are a huge number of people who have not recovered from that. If you were an owner of a hair salon and you were locked down for 200 days, when your customers came back, they didn't come in to get 5 haircuts. They only came in to get 1. You can never catch up for something like that. So a lot of this is now the overhang from that, which caused greater debt, obviously greater tax debt for a lot of people. And then, of course, it has led to inflation, which has caused higher expenses too. So it's really the person who's just can't afford to make ends meet who are what we're seeing today.
So looking at it from a big picture standpoint, everyone's hoping and waiting for the Bank of Canada to cut rates. Could you make the argument that if they cut rates, they'll make things worse because people will just borrow more and get behind even further in their payments and insolvency will increase even more?
Perhaps, but I think what is your capacity to borrow? So the people we're seeing now have a lot of credit card debt. They had incomes good enough to get a good enough credit score to borrow against a credit card, as opposed to a something like a payday loan, which takes much less of a credit score. Well, if interest rates start dropping tomorrow, which they're not going to, but let's say they start dropping in May, is that going to increase people's credit scores? Well, no, they've already got the debt. So I don't think it's going to lead to a splurge of borrowing, because the debtor is already tapped out. They're already at their max. So even if interest rates come down for that segment of the population, it's not going to make any difference. They've already got more debt than they can handle. And I don't think banks are going to all of a sudden say, oh, you're already capped out, but the interest rate's a quarter point lower, we're going to lend you more. I don't see that happening anytime soon.
Your report also addresses what you refer to as homeowner insolvencies. What is a homeowner insolvency? Is that a mortgage default, or is it something else?
No, it's somebody who owns a home at the time they file an insolvency. If you go back to 2011, it was about a third of our clients, but back then houses weren't worth that much. There wasn't a whole lot of equity, so you could file a consumer proposal, maybe you had $10,000 worth of equity in your property. We do a proposal where you end up paying that equity back over a period of time. Everything's good. You go to 2022, August of 2022, 0% of my clients owned a home that month, because house prices were so high that even if you had $50,000 worth of debt, well, you probably had $200,000 worth of equity in your house. You didn't need to file an insolvency because you could refinance, sell your house, whatever. Well, now we're starting to see prices go down, equity being diminished. So we are starting to see a few people who own a home actually filing an insolvency. We have not seen the wave of defaults yet, and maybe we never will. I don't know what's going to happen in the future. But a homeowner not only has a mortgage, obviously, but they also have much higher unsecured debt. They've got higher credit card debt, higher, car loans. All those things are much higher because they have greater capacity to borrow. So we are starting to see homeowners filing insolvency, and that will probably be the story over the next year or two if the real estate market does not have some dramatic pickup to bail those people out.
We have less than 60 seconds left. Do those people keep their homes if they're a homeowner who files for insolvency? As they work through that debt, reach an agreement with creditors, do they keep their homes?
Yes, it's possible to keep your home, because that's exactly what you're doing. Here's the equity I've got. Let's make a deal where I pay you that equity, maybe a little bit more over a period of time. So in a consumer proposal, yes, you can absolutely keep your home.